Well, thank you so much for having me here today, and let us get rolling. So what I'd like to talk to everybody about here today is how to trade market volatility by incorporating selling options for both profits and hedging. So let me show you what we're going to be covering here. Number one is to avoid the number one option trading mistake. Two, the most important option factor for your various option strategies. Three, how option pricing works so you understand the different option strategies out there. Four, knowing and using the market maker's secret. Five, highest probability option strategies for any type of market. And six, an option trading defense for extreme markets or any market in general. So the following webinar today is purely for educational purposes. Any stocks, options, futures mentioned does not constitute advice and should not be construed as a recommendation. So yeah, thanks for the introduction. Yeah, I've been actively trading for over 30 years and was previously executive vice president for a company called Trans World Oil and was one of the largest oil trading companies in the world and ran their international trading desk there for over 10 years out of Bermuda. So a beautiful spot if you ever get a chance to go check out the island. People are great, beautiful place. Had the privilege of being there for over 15 years and ran the trading desk there for 10. So we were one of the first groups to start trading over-the-counter options on crude, and that's where I got my start trading options, and then went on to launch the institutional over-the-counter crude oil options brokerage desk for another company called PVM Oil London, which is the largest privately owned oil brokerage company in the world. So just another great learning experience there for me as far as options go. Now, here's Bermuda back circa 88, and the main thing is, when you look back and you look at trading for yourself, it definitely can be one of the most rewarding jobs out there, but you really need to stay educated about what you're trading and stay focused on managing your risk. That's really one of the most key things that you can do in your trading. And probably, as everybody here can attest to today, it can also be a very painful profession at times. So what I want to try to emphasize today is the importance of your risk management, because when it's your own money, those losses become so much more personal. And for me, my kind of really aha trading moment actually came when I started to incorporate more option selling type strategies into my current trading. So step one is to avoid the number one option trading mistake. And option trading has so many more advantages than trading stocks, but as you probably all know, it can be a little complicated at times as well. And for individual traders, options can be a little intimidating, and that's why many investors will trade options by purchasing out-of-the-money options, often short-term options, since they cost a lot less than your long-term options, and it's basically a pretty simple strategy. So for example, out-of-the-money calls or options in general are especially very popular because they can be very cheap and seem to follow the old Warren Buffett paradigm that we all kind of love and grew up with. Let's buy low, sell high. But is this always the best option strategy? So imagine that you're bullish on Facebook and it's trading at $100. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike of 120 at a cost of 15 cents, which would be $15 per option contract. Now, why would you do this? Well, when you do the math, you can see that you could do lots of them. So if you were to purchase 100 shares of Facebook for $100, that would cost you $10,000. But for that same $10,000, you could go out and buy 666 contracts of the 120 calls and control over 66,000 shares. Wow, when you look at that the first go around, it's pretty amazing. So then you do a little bit more crunching the numbers and you say, well, what if Facebook was to hit $121 within the next 30 days, and those 120 calls would now be trading at $1.05, which would be $105 per option contract just prior to expiration. Well, you do the math on that and you can see that you make over $59,000 in 1 month. So at first glance, this kind of leverage really is awesome, but you don't want to let this glitter fool you, because not losing money is just as important as making money. So the one problem that you have with short-term out-of-the-money options or calls in general is that you not only have to be right about the direction the stock goes or moves, but you must also be right about the timing. Now that really ratchets up the degree of difficulty. And to make a profit, the stock doesn't just need to go past your strike price, but it also has to do so within a defined period of time. Now, in the case of the 120 calls on Facebook, you need the stock to reach 120 within 30 days to make your profit. So it's this dual objective of having to be right on direction plus timing is what really lessens the probability of an option trade being a winning trade when you're just always buying options. And everything I teach my clients is, really based on your risk management and also increasing the probability of your winning trades. So in this Facebook option trade example, you're wanting it to go up and move more than 20% in less than a month. And this is kind of like a 2 standard deviation move. So really, how many stocks are likely to do that? We'll see the occasional big runs from certain companies like a Tesla, etc., but in all reality, not many. So in all probability, the stock would not reach the strike price, and the options would expire completely worthless. So based on probability, and with options, that's a great thing too, we can theoretically measure probabilities using standard deviation. There's only about a 5% chance for the stock in this example to reach 120 to 121 by expiration. So in order to make your money on out-of-the-money calls or options in general, you need to either outwit the market or get plain lucky. And there's an old phrase in a blues song that said, if I had no bad luck, I'd have no luck at all. And that kind of pretty much summarizes which way the luck usually turns, right? So being close means no cigar. Now imagine that Facebook was to go to $110 during your 30 days of your option lifetime. Well, you could pat yourself on the back and, you say you're right about the direction the stock would move. But since you're wrong about how far it would go within a specific time frame, you'd still lose your entire investment, and that's always, outright painful. So based on this trade example, a better goal for really every trader, in my opinion, is to select those trades that are based on what provides you the most consistent positive returns and not that one-time big winner. And consistency is derived from making high probability trades based on reliable data and facts. Now where there's a big disadvantage, such as the one you saw in this option buying scenario, you can usually just look at the flip side of the coin and see an equal and opposite advantage. So in this case, if you were a seller of options, that would give you a huge advantage over being a buyer of options. Now, all the professional money, they know this, and so they try to always take advantage of being on the sell side as much as they can. And, you can too. So as a seller, all the things in this example are the same, but in your favor instead of against you. Now, this is why a lot of people like to take advantage, and especially professional traders like to take advantage of selling options for both profit generation and hedging. So, by selling options, you can look at it as you're, in essence, selling time. And that's a really powerful dynamic to add to your trading. And it's this strategy that's yours for the taking if you understand it. Now, an option, you can also look at it and think of it as a coupon, like you get at a grocery store. So it has to be redeemed by a certain expiration date, or else it's no longer going to be valid. But how is this done, and then what's involved? Well, step 2 comes down to the most important option factor for income generation, and it's the understanding the concept of time. So you can kind of see that in that Facebook example. So it's relatively simple. Now, time is what is used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. And option income type strategies are very, very tied to the time value and the impact that has on the price of an option. So time value is also what we call the extrinsic value of the option. It's the premium that a rational investor would pay over its current exercise value, known as the intrinsic. And this is based on the potential that it will increase in value before expiring. Now, this probability is always going to be greater than 0, thus an option is always going to be worth more than its current exercise value. So, as an option buyer, if you get additional time for your trade to work out, you're going to be willing to pay additional premium for that time. And the seller is going to want additional premium to have that risk of giving you that time. So let's take a look at this next chart, and you'll see how predictable and powerful this kind of option paradigm is, and I want you to answer a question. So if you look at this time value chart, you'll see that when you start out further out in time, you are going to see that the time value is going to be very, very slight. And it actually is almost like flat. Now, as you get closer in, 30 days out, and then you get into your weekly options, that time value really accelerates and goes down dramatically quickly. So you can kind of think of it as a swift tide moving out. And if you're trying to swim against that tide, it's very difficult. So it's the same situation if you're buying options as that time decay is going towards zero, which it gets to at expiration. So here's the question. Let me move that aside. So if you were to have the underlying security, let's say it's Apple or something, and it was just to go sideways, really not having much movement at all, it just kind of bounced around in a dollar range or so sideways with no direction to it at all, would you have wanted to have bought options 120 days to 90 days out, or would you have rather sold the options, knowing the impact of time decay? So if you'd rather have sold the options, knowing it's going sideways to no direction, put in a 1. And if you'd rather buy, put in a 2. And that's right, everybody pretty much got it right. So, you know, if the market's moving nowhere, you know the impact that that time decay will have. So if you're long an option, it's going to go against you. So if you knew that ahead of time, you'd rather sell options every time. Now, this is the common natural value or time value progression for all options. And it's seriously, if you're not aware of it, it's like falling off a cliff. You're just blindfolded. So step 3 then is, well, how does option pricing work? You know, and what are the components to make a price of an option go up or down? Well, the value of an option, the basic components will be time value times the implied volatility times the intrinsic extrinsic value, the underlying value of it. So these are the main components. There are other variables of Greeks that go in, but these are the main components. And once you understand these variables, then you're ready to, you know, price and understand the option pricing mechanism and know what option premiums it should be. Now here's another example of this time decay and how it works for you or against you. So in this chart here, get the pen, this is basically a weekly option series. So every Thursday you have a new series that comes out, and when that comes out the first day, you've got 100% time in that particular option series. So time value times the implied volatility times the intrinsic extrinsic value, the underlying value, that's what determines the premium of the option. So day 1, you've got 100% time. If you have implied volatility at 300, we'll keep this constant. You can see then your premium is going to be 300. Now if you look down here to Monday, you can see that, you know, you come back after a weekend, and Monday that time value is cut in half. So it really diminishes the part of your value. And even if you have a big spike in this example, like up to 800 on the implied volatility, it barely moves the premium of your option up. And then think about if you had, you know, implied volatility was lower, say just 300 like it was above. So then your option actually is going down in price, so it would only be 150. So these are two major components. You can see time value and implied volatility, and you know they're both going to go to zero at expiration, so it's going to have a big impact on your options that you're buying or the strategies that you're using. Now here's a key component too of options, and this is a really great thing to understand just for trading in general, and it's kind of what's known as the market maker's secret. It's kind of what they don't want you to know. It's how they can make really good, easy, quick money off of you. But if you look at broad markets, you'll see that they'll tend to go in cycles, and you'll have 2 to 3 week cycles where the markets will trade, you know, maybe sideways. And this is going to be more of the kind of general pattern, 70 to 80% of the time. You know, you'll have those nice, you know, spikes up or trends down, but then all of a sudden the markets go sideways. And we're kind of in that sideways pattern right now if you look at the broad markets. And it's based on this sideways price movement that the out-of-the-money option buyers are going to start losing. They're going to lose approximately 70% of the time under this kind of condition. And the market makers, they know these statistics, so they're going to usually tend to trade from the sell side as much as they can, knowing this. And this is the professional money. So you need to think exactly like these market makers are, thinking, and it's all based on the math. So market makers use mathematical market probability statistics for pricing out the movement of an option to its expiration. And now it's pretty much a level playing field because we all have access to good option platforms, so we can know the same input, for our option trades as the market makers. And by knowing the probability of an underlying security finishing within a certain range, price range at expiration, is really key when you're trying to determine what options to buy or sell, and then what option strategy you want to use. So it's these statistics that forecast how likely it is that your option will fall within a certain price, up or down, by its expiration. And this this statistical forecast is what we refer to as the implied move of your stock, or the implied move of the underlying security you're trading. And it's this implied move that's an estimate, a theoretical estimate, of a plus or minus 1 standard deviation move of the underlying security. And we can, measure these movements using the standard deviation. So here's kind of how it works. This is, you've probably seen this before, maybe statistics that you've taken or whatever, but this is what's known as the normal bell curve, the normal distribution curve for data. And in this example, it's a distribution of price. So, based on probability statistics, if you're selling options or option spreads, when you do it correctly, it's going to give you the highest probability type trade setups for generating consistent profits. And here's a big thing too, for me, it's a great way to hedge your risk. And it's all based on the math of probabilities. So if you have an option, let's say you have, this is Google, and it's trading at $500, that's at the money, so that's on top of that bell curve. Now, on your option platform, you're going to be given this information. You're going to be given the implied move, so plus or minus 4%. So that's going to be 4% based on days to expiration, in this example, 10 days. So 4% up would push it up to 520, 4% down is 480. And it's this movement from this 480 to 520, that's what we call that 1 standard deviation move. And in statistics, that's approximately 68.2 probability. So this price point from 480 to 520 is kind of the normal distribution of price movement, for an option, given this information. So how this helps you is that you can then see that, if you're looking at a trade, you can see that your probability is that, yeah, it can go to 520 or it could go down to 480. The range that it's going to trade is more normal between these two prices, 68% of the time. So if you start then going outside of that range and buying options way out there, say at that 2% level, and let's say that's 580, then you can see that your probability of that being a winning trade goes down. So it's only about a 2% chance as you go out, or as you go out on the puts. So by knowing these probabilities, it can really help you to set up your price targets. Even if you don't use options, you can use this for good price targets because there's so much options being traded every day, more than the volume of the underlying. So also then when you come back to trading, trading is a business of probabilities. And to be successful, a trader really needs to be focused on controlling your risk. And one of the most important steps in that is knowing the winning probabilities of the trades that you're taking. That's where the options are so great, because it can give you these probabilities, whereas if you're just trading flat price, you don't have this tool to help you get probabilities. So one simple and free tool actually for measuring this is the option delta. So you'll see that the option delta is a great, what we call one of the Greeks, but it's a great tool because it gives you the value of the option movement based on the underlying. But the other big thing, if you don't even trade options, this is one thing that you can use the option delta for in your trading, is it also helps you to measure the probability of a price move on the underlying itself. So if you were to take back at this bell curve and you see an option delta of 68 to 70, that basically you can also look at that as being that strike as having a 68 to 70% probability of being in the money at expiration. If you have an option delta of plus or minus 16, that's then equivalent to that outside point of 520 if you look at it there, which is your 1 standard deviation point out, and that's also equates to that 16 delta also equates to like a 16% chance, theoretically, of being in the money. So then you can use these probabilities, okay? So even if you're not trading options and if you bought Google at 500, then you can look at your option delta and say, well, I've got a 16% probability that it'll be up here to 520, but the movement will be between these two levels here. So if I'm going further out and buying options, I've got a less chance of winning. So if I'm buying something inside here, you can see how your probabilities go up. So it's a great way to set realistic targets and good targets for your trading. Now here's what it looks like on your platform. This is Thinkorswim. This is the analytics, and so this is a 1 standard deviation move set up on Thinkorswim on Google based on what I just showed you. So here's the at the money price, 582.45. Here's days to expiration, 22. And here's the expected move over here in the right corner, plus or minus $34. So all the information is there for you if you know how to use it. So Google's trading at 582. So this is saying that Google could go up to, by $34 up, or it could go down $34 from that 582. Now, if you want to see what the 1 standard deviation move would be, you can use what we call price slices on your analytics, and you can set that for a 1 standard deviation move. So I just wanted to show you how that relates to just using the delta, so you don't have to do this kind of input every time. It's real quick and easy, but I want to show you how it does relate. And so if you set that to 1 standard deviation up here and down, here's that 1 standard deviation move would be 622 to the upside based on that input. Now, what I do is the back and dirty type envelope, and I look here. If I look down, you look at this 620 strike right there. Here are your strikes. You look there, and then you go over to the delta, and you see that shows you an 18 delta. So basically, that 620, the way I can look at it is that it's got an 18% chance that Google will be at 620 by expiration based on 582. So this gives me a great information for trading probabilities. Now, using probability analysis, provides trader or investor a very useful tool to determine price targets that you can trade against, and it's also great for setting hedges. So again, based on the math of probabilities, you can see that approximately 68.2% of options bought expire worthless, and based on this, it's a good idea for all traders or investors to consider not only just buying options, but also look at selling options. Now, this added option strategy for profits and hedging will make a dramatic and positive difference in your performance when you use it correctly. So all the professional money, they take advantage of these options for selling, for profits and generation and risk management, and so can you. Now, next step, though, is selecting the right income option strategies. So, the goal for each trader should be really to select trades that are based on what provides you the most consistent returns and not always that, one-time great big hit. So you want to be consistent in your trading to have a consistent equity curve. And one of the best ways to do this is by then knowing what are the income strategies out there and then selecting the one that's best for your trading style and trading plan. So everybody here today will have a different amount of capital you can trade, a different amount of risk you want to take, and so you can develop your trading around your profile of risk and the strategies that are available to you. So for this type of income type strategies for selling options, you've got the covered calls, calendar spreads, diagonal spreads, long iron condors, and credit spreads. So these are kind of the main kind of income selling strategies. They're all good strategies, but some are better for certain conditions. So, if you've got a market that's been consistently moving up and you've been buying the underlying selling calls against it, covered calls are great, but what happens when the market rolls down? You can see the problem there. For me, my favorite then comes down to the credit spread. And it basically, for four really great reasons. The credit spreads can work regardless of market direction. They can almost be always right, even if the trade looks like it's going wrong. The winning probabilities, of profit is over 68%, even without adding technical analysis, which then you can imagine increases that profit probability even more. And it's a perfect strategy for hedging if you get in trouble. So there are three types of credit spreads. You've got the bear call credit spread, you've got a bull put credit spread, and you've got the long Iron Condor. Now, the bear call credit spread is, a great strategy if you think the market's going to go down. It's a bear strategy. So you're going to be selling one call with a lower strike and buying another call with a higher strike the same month. So that's what we call the bear call credit spread. So here's basically what it looks like. So if you've got, here's the S&P 500. It's traded at 1980. So in this example, you're selling this bear call credit spread way up here above the market. This is like one standard deviation. So selling the 2045, buying the 2050 above it. You bring in $100 credit. That goes straight to your bank account. The difference of 400 is your capital at risk if you get it totally wrong, and that's the margin that you put up for the trade. That's all you have to put up. Now, so if you don't defend it, you could lose 400, but you're going to make 100, and if it goes and expires below that level there, that's a 25% return. So these can be very consistent, high probability winning trades. The next strategy is a bull put credit spread. It's best used if you think the market's going to go up. So this is where you're selling a put, one put with a lower strike, and then where you're selling one put while simultaneously buying another put with a lower strike in the same month. So here's an example of that. So here's, if you're bullish and this is win and it's trading right here and you think it's going to go up, instead of buying stock or buying the options, you can sell a bull put credit spread way down here, way below it, a lot more tolerance and a lot more forgiving. And in this example, you bring in $130 credit. The maximum at risk is 370. If it closes above that area here of your spread, that's a 35% return. If you do nothing to defend it, you lose 370. That's all you have to put up on the margin. So they have a lot of great benefits. Now then the third one is your long Iron Condor, which is just combining the bear call credit spread and a bull put credit spread together. So what I want to show you next, though, this is the real kind of eye-opener, is when you compare the risk reward to two long directional option strategies. First one is just buying calls outright. The second one is selling an out-of-the-money bull put credit spread, both bullish. So strategy one is you're just going to buy the 207 calls on win at $11.40. That's $1,140. Strategy two is you're still bullish, but you're going to do a little bit different, more conservative strategy. You're going to sell the 187, 182 out of the money bull put credit spread. And it's going to be below where win's prior low was and 9.5% below where it was trading at the time. So strategy one is a great strategy. If the market keeps going up, you've got unlimited upside potential. Your max risk is premium paid, but that can still be a lot of money. So here's what it looks like. So we're going to say John, he was very bullish on win, and so he bought the 207 calls right here at the money. It looked great. It was going straight up, and then all of a sudden, as we've seen so many times before, the market rolls over. So he comes in and opens up his P&L on the 8th, and all of a sudden, win is trading way down here at 196. So now John is down $583. Okay, so that hurts. That's not good. Now on the 21st, though, win pops back up, and it looks better. It's back up here into this area. It's trading at 205, but John opens his P&L, and he's still down 518. So he's not much better off at all. Now Susan, though, she's bullish, but she's going to do a bull put credit spread instead, kind of diversify her risk. So she's selling that credit spread way down here below where win was trading there. So she was able to get a $130 credit. And as long as it closes above here at expiration, that would be a 35% return. Now the market falls off, which you saw earlier, and so Susan opens up her P&L when that market it was down here at 196, and she's only down actually $38.50 because she sold that bull put credit spread way out of the money. And then on the 21st of May, she opens up her P&L after it's come back some, and she's actually making money now, $78, but John is still down 518. So you decide which one looks better in that kind of market condition. So it's a big difference. That's the beauty of it. Now, the thing that I love about selling options, and you can do selling options naked or you can do it with these credit spreads, it's just one of the best defensive strategies out there for hedging. So here's an example. I call it kind of the offense-defense trade strategy. So this is on S&P 500, the SPX. So the original position was short a bear call credit spread, and then the trade went against that short position. So this trade was then hedged by converting it with a bull call debit spread, and it converts it to what we call a butterfly, a balanced butterfly. So the original trade setup was based on direction, and the market was moving up nicely. Then it stalled right here. So set a bear call credit spread, wet 1 standard deviation up above the market. So the market was at 1940, and then sold you'll see in the next slide, a 1980-85 bear call credit spread. Now, whenever you do a trade, you should always have a defense strategy set up. What are you going to do if the trade goes against you? So in this trade strategy, or this particular trade, the trade was put on right here, selling this bear call credit spread up here of the 1980-85. Now, my plan was, if it was to break, this was a 50% retracement level. If the market was to break this 1945 level right here, I was going to hedge it, because there was a good chance it could really break to the upside. So always have a kind of what I call a line in the sand of what you're going to do in a certain situation. So here, let's walk through this trade. So here, the first trade setup was selling that bear call credit spread, and it was trading, the market was at 1940, so sold the 1980-85 bear call credit spread. It was approximately 1 standard deviation out of the money, so that gave me a 68% chance of winning just as soon as that trade was put on. Brought in $100 credit. The difference, it was a $500 wide spread, would be $400 would be your at risk. Now, if it trades and closes above, in the spread is okay, that's a 25% return. So the key is, when you put on a credit spread out of the money 1 standard deviation, that gives you a 68% chance of winning when you put it on. So that's a high probability of winning. So that's why it's done. Now, but you also have to consider that certain things will happen, and every trade won't be perfect. So here was a Fibonacci level, 1945, 50% retracement, and I love to use Fibonacci. So my plan was, if it was to break 1945, I was going to immediately hedge it. So here you can see my bear call credit spread up here. So here's what I did to hedge it. It's a very simple way, quick way to do it, to cut your risk. So trade 2 was then hedging it. The market broke 1945, so I bought a long call debit spread to offset the vertical bear call credit spread. So when you combine the two together, it's a perfect hedge. So this was going long the 1975 call, short the 1980 call. Now that cost me $165 per option contract. Okay, so I had to pay out $165. Now the potential profit was $335. So here's what happens when you combine those two together. It creates what we call the butterfly. In this situation, it's what we call the balanced butterfly. So the basic first trade was short that bear call credit spread 1980-85, collected $100. The second was the hedge, the debit spread 1975-80, collected, paid $165. So you can see they share the same short strike. That's the body of the butterfly. Now, when you take $165 debit less the credit received, now my risk is cut down to only $65. So I went from a potential at risk of $400 to $65 either way. So for me, this creates a low stress trade as well. And then I have time to think, what do I want to do next with that trade? So I went from a potential loss of $400 if everything went against me, just to a maximum loss of $65. And I've got a great setup. If it closes in here at that short strike, I can make a lot of money, or I can leg out and keep the original position or convert it the other way. So it gives you a lot of different options. So trade 3 was closing the trade out. And this was done when the market was kind of peaking up to the top and starting to turn over. So the first thing I did was I sold off the long call debit spread. So sold that off. Cost was $165. Sold it at $335. So made $170 profit. Okay. Now when the market, it was kind of cresting up there that one day, and then it started rolling back down. When it started rolling back down, I waited a little bit, and then I had to cover the credit spread side. I'd sold that $100. I had to buy it back at $245, so I lost $145. So basically made $170, lost $145. So net, this trade ended up actually making $25 per contract, which doesn't sound like a lot, but that's still a 6% return. So $25 versus losing 400, I'll take that all day long. Now the next thing I do, you treat these kind of like a campaign. So I waited, and then I reset the trade. Once the market had moved up and started rolling back over again, I reset the trade with a new credit spread, and that was on the 21st. And so what I did was just sell another credit spread, the 2070-75, collected that time $120, and then a couple days later the market just finally crashed. It went down to $5, bought it back, made $115, $30, or 30% return. So that's the beauty of credit spreads, and that's the beauty of using selling options, if you know how to do it, to hedge a position. So you can do it with debit spreads, credit spreads, anything. So here was the beauty of it, and here's just the last chart to kind of illustrate this. So, when it came back up here, peaked out, sold this 20-70-75 bear call credit spread there, rolled over, covered back. So these are things that you just kind of constantly work on. It's kind of what I call that campaign. But it's one of my favorite go-to trades. So I wanted to really share that with you today. And if you'd like to learn more about these type of strategies that capitalize on time decay, I've got a great package that's offered for you guys today if you'd like it. And this is a course that I did about a month and a half ago. It's how to sell options for profits and hedging, just what I was showing you today, but it's a 5-hour course. And this course is an extensive course, just 100% on using these type of trade strategies, credit spreads, and selling options for both profit and hedging. So it's a 5-hour on-demand course, and it's got a 270-page PowerPoint manual. My courses are very detailed. Plus, you're going to get my what I call my option strategy manifesto. It's my favorite option strategies in a really nice diagram package that you can print out, put on your desk, and my Greek power tool guide. So this gives you all the you can print this out put it on your desk for all the Greeks. And then we'll do one live follow-up Q&A. That's also part of the package. And if you've never been a member of my trading club, I'm going to give you a free month there, which is $97 after. So powercycletrading.com/like. This is $97. If you don't like it, you have zero risk. You can just send us an email and we'll refund your money. But it's a great package, and I'll leave this open here for you guys. Usually I'd like to limit it so I can make sure I can answer all your questions, but if you'd like to take advantage of it, there's the link, powercycletrading.com/ just the letter LIKE. So you'll get my step-by-step blueprint course, trading option credit spreads for profits and hedging. It's a 5-hour course, 30-minute modules, 270-page PowerPoint manual you can print out, live follow-up Q&A, 1 month free membership if you've never been a club member, my Greek power tool guide, and complete option manifesto. So here's just a little bit of feedback from a couple members. Thanks for the wonderful credit spread, Larry. The class was thorough and expansive on immense flexibility of credit spreads. Thank you again. But it's a great rewarding pleasure for me to get positive feedback, and I constantly have been getting lots of good feedback because I put so much into my courses. And then again, you'll get my option bonus 15 strategy diagram. This is a diagram of some of the option strategies I like covered calls, ratio spreads, ladder spreads, etc. So you can print it out, put it on your desk, and then you'll get my options Greek guide, which is the Greeks, and you print that out, put it on your desk. Now the course, I can kind of go through it here quickly to tell you kind of a summary of what's in it, but again, it's a very extensive course, 5 hours. So what are the option Greeks that are used? What's important for these types of spreads? That's covered. How to use the credit spread to create these low-risk, high-probability trades. Big part of the course here, I'm big on hedging, so when and how to use these credit spreads for hedging a core trading position. Any kind of position you can adapt to using these credit spreads for a hedge. And then how to use the credit spread on those indexes like the S&P 500, SPX, NDX. I like to use those a lot for these out-of-the-money credit spreads, either bull put or bear call. When and how to use it deep in the money where you get a positive risk ratio spread set up. How to steadily and consistently grow a small account. You can see that the margining is very small, and these can be very consistent types of trades. And then I also teach you 6 defensive strategies for these credit spreads. So, you know, various different conditions that could happen, how to defend those 6 different strategies, when and how to use the Iron Condors. It's not something I use that much, but I'll tell you when and why. Great for position sizing to diversify your risk. And then, you know, again, how you can turn that 70% probability into a bigger probability winner, and a step-by-step guide for executing the spreads. Some really good technical analysis. I like to use Fibonacci, so we show that in there. And then when do you put these types of trades on? 5 days, 10 days out, 30 days out? I'll tell you that, when to take them off, and then how to trade these spreads into the day so you're not, you know, bug-eyed. And then you get a great credit spread library that goes along with it. So a lot of great information. So even if you're not a big option trader, but if you want to try it out, kick the tire, here's your chance. And it's got a money-back guarantee, plus you get a free 1-month trial. Got a virtual trading room open every day. Do daily market updates, videos every night showing you the trades and what the market's doing. How to use weekly options. We do a Q&A every week, hour and a half Q&A. Trader's Vault with all kinds of good educational stuff. So just a vast amount of great information and a money-back guarantee. So it's a win-win situation. Hopefully everybody here will take advantage of it, and really appreciate your time here on a Tuesday. So thank you very much for being here. I think I've about done my time here.